Okay, it's about that time. You've heard it time and time over. Price action, price action. Price action's king, price action this, price action's that. It's time to finally get involved, and let me show you why it's king and why I am personally a price action trader, and I'm one of the biggest advocates out there for pure price action trading. This is going to be an amazing experience. I'm going to be showing you a ton of things, and this should expand your market knowledge in terms of the types of opportunities that are available to you, and this will just expand the general opportunities in totality of all the different options you have in order to trade. This is going to really help cement your understanding and your knowledge, even more so if you come from a background of paying for education that gave you some signals and said do this, do that. This is going to take you to a whole other level and put you miles ahead of all the rest in your trading journey. So I'm super excited. We're also going to be covering Fibonacci in this particular video, which is one of my favorite teachings. It just blows my mind every single time. Even after I teach it, I look back and I just go, wow, this is something else. This is amazing. Okay, so without further ado, if you guys are ready, I'm ready. And obviously I'd love to know from the previous video, how did you find the investing mindset and psychology session? Is there some things that have been cleared up for you? These have been some of the big breakthroughs I've made in my trading career, and I believe this would obviously have helped you quite a bit. But this section is going to be mind-blowing. As always, leave your comments down below. How did you find it? What types of things were you struggling with? And I will obviously go back and read every single one of those comments. I'll reply to as many as I physically can. Beautiful. The most amazing part about this whole series, guys, it is free. You can share it with whomever you want. You can share it on Facebook. You can give it to a friend. You can do whatever you want with it. It's an absolute gift from me to you. Dream come true, in all honesty. Okay, so let's jump into it. Price action, price action. Let's jump into it. All right, let's have a look at what we're going to be jumping into and what this whole price action setup is all about. So as I've been saying time and time again, price action is king. And let me just quantify or qualify that particular statement, right? And as I've alluded to a little bit earlier, there's multiple studies of people who obviously started their journey and who've obviously seen a lot of this information and obviously migrated. And like I said, there's titans of the industry that believe 100% and stand behind price action as one of the purest forms of trading. But let's jump into it. So over the last couple chapters, over the last couple videos, you've learned some of the fundamentals of price action, and I've structured the learning in this particular way so that you can fully grasp this particular concept without feeling overwhelmed, without starting with resistance and support and then jumping into all these formations. I've particularly staggered it in this way. You may feel some of the things were incomplete, and they were there for that particular reason, just to introduce a concept and let your brain chill, and then we move on to something else so we can make it complete in this particular video series or in this particular video. So again, you've heard price action a ton of times. So what is price action? I've spoken about it a million times. What is price action? So price action is a form of technical analysis where we use techniques to read a bunch of the historical data and current data of price and deduce the most logical and likely movement of price without the use of all these other instruments like indicators, so on and so forth, right? As I've explained before, most seasoned traders have admitted after 3 or so years of trading experience that they all started as algorithmic traders or traders who solely use indicators, and after finding that indicator trading is not sustainable and consistent, switched to mastering price action, and then incorporate at a later stage use some of these indicators to be able to support their price action analysis. In theory and in summary, price action has stood the test of time to prove that it's something that's lasted many, many years and will still be relevant and last many, many years to come. Okay. Now, when we have a look at it, right, you'll find that there are hundreds and hundreds and hundreds of candlestick formations, as we've discussed earlier on when we spoke about pin bars. Now, I have not found that understanding and naming every single one of these dojis and every single one of these formations has been profitable, right? There's a ton of different formations. Every shape that you can connect dots to has a formation and has a name under the price action banner. But essentially what I'm going to be doing is I'm going to be essentially taking out all the rubbish and applying what's going to be most relevant for you and what you're going to find the most profitability and consistency in. Now, there are, again, hundreds and hundreds of different ones. Please, at the end of this episode, comment down below what are some of the price action formations that you find the most useful if they're not covered in this particular video. But these are going to be the items that I find most valuable in my own trading toolbox and arsenal, and this may be different for you, but ultimately these are going to be the things that help you out the most. Okay, so some of the very first price action formations that we're going to talk about that are absolutely amazing to spot and to trade are what we refer to as triangles, right? We have a rising or ascending triangle, and then we have a descending or a falling triangle. Now, these are amazing to spot, but there are quite a few conditions to them being valid. Okay, the first one being that when a triangle is forming, right, we do not reach the point of apex. So the apex point is the point where the resistance and the sloping diagonal come to meet. That exact point, which is represented right there at the end, that is referred to as the apex. Okay, so the price action formation should not reach the apex. If it reaches the apex, then this probability is then dead and it can go any way. Then you're just waiting for a breakout to determine the new market price and structure. So when we look at a triangle, what we're seeing is that we have consistent resistance. Let's talk about a rising or ascending triangle. We have consistent resistance. We've got buyers and sellers that are obviously battling it out, and we're seeing that prices are reaching a ceiling, right? We're failing to get any higher, but at the same time, we're making higher lows. So the duty of a bull or a buyer in a market is essentially to make higher highs, and obviously push to make sure that we obviously make higher lows. So you want to see in a price action formation, simply look at it in comparison with this fight that I've been talking about, this war between buyers and sellers. So buyers want to make higher highs and they want to make higher lows. So they want to trend in an upwards direction. That tells you that that market space is overwhelmed by buyers in that particular setup. Now, sellers want to essentially make lower highs and lower lows. They want that market to trend downwards. They want to overwhelm that market towards the downside. So when we see a formation like this, it's also important to understand what's happening in the background, not just to obviously learn to parrot spot, I see that that's what's happening. You've got to understand the context of why it's happening and what market participants are involved here. Okay, so we can see that the buyer's job is to make these higher lows and the seller's job is to make the lower highs. In this particular case, we can start to see that we aren't getting as many sellers in this particular market as we are buyers. So in a rising or ascending triangle, we're seeing that buyers are overwhelming this market. Sellers are unable to make those lower highs, but buyers are making higher lows. So they're edging that market closer and closer. Now, what the ultimate goal here is that we generally want to see an ascending, a rising or ascending triangle break out towards the top side. Now, there are a few conditions to that. The rising or ascending triangle must break out between 50 to 70% of its formation. Now, you might be saying, okay, Well, what do you mean it's formation? It's not even done yet. Well, essentially what you do is you measure the formation of the triangle. So from the candles that have started, we look and count the periods. So when you have a level of resistance, you draw that resistance right to the end. And when you have that diagonal area of support, right, you draw that towards the end. Those two will meet. At the point where those meet, that is the full market structure. So let's say you measure that. The whole market structure is 100 candles. Let's say you're drawing it out on an hourly time frame. It's 100 candles, it's 100 hours, trading hours that it's taken to form. We want to see a breakout happen between 50 and 70% of that formation. That's what we expect. So if it goes past the 70% mark, right, so it goes past 70 candles, it's more than likely going to go to the apex, and then that move is dead. Then it's anybody's game. We could see a breakout towards downside, a breakout towards top side, whatever the case may be. So a rising or ascending triangle is a price action symbol that we will get a breakout towards the top side. When we look at a descending or falling triangle, it is the exact opposite. So we're seeing the sellers in the market overwhelm the buyers. The sellers in the market, their job is to make those lower highs, and a buyer's job is to make those higher lows, and they're not necessarily getting that right from a buyer's perspective. So this particular market structure indicates an overwhelming presence of sellers in this particular market. Same rule applies. We want to see this market break out towards the downside between 50 and 70% of its formation. So generally speaking, when we start to see these triangles, we get quite excited because it's an early indication that, all right, we might see a massive move towards the downside, we might see a massive move towards the top side. So that starts to allow us to prepare. So we could start to, as an example, there's multiple ways of taking advantage of this or trading this. So when you see a probability of a price action setup evolving, you don't just want to wait necessarily for the breakout and then you wait for it, agree test, and then you take it, because a lot of the times these can just run, right? The breakout can happen, you've missed it, you don't wait for the retest, it takes 2-3 days to come back, you've missed that too, and then it's gone. So you want to take a trade that's in the highest likelihood of the direction that this breakout is going to happen. So when we look at a rising or ascending triangle starting to form, you can see that we hit a high, we hit a resistance, right? We come down, we make a low. We hit a high, we come down, we make a higher low. This is the entry points that we want to start to create buy orders in, right? So we want to start buying off of this diagonal support, because if we can buy low enough and the breakout happens, we can protect our trade with a stop loss within that triangle structure, so if markets come back, we can at least secure some profit. So this is a great way of getting an early trade out in the market, specifically when you see a market formation start to range and then it starts to hit these levels of resistance. Then as soon as you find an entry on a diagonal support, that's your point of entry and where you want to get in. In terms of a descending triangle, the equal and opposite will apply. So we have an expectation for a breakout towards the downside. So we would want to look for essentially a bounce off of resistance, diagonal resistance, because we know the likelihood is to obviously bounce and break out towards the downside. So we will look for an entry there. And once markets break, we would protect our position by placing a stop loss in the structure itself. So should markets come back into structure, we get taken out and we get taken out with profit. But should they break out and run, we're in the money in a very, very big way. So these are two price action formations that I absolutely love, and they have proven to be extremely profitable when spotted in a timely manner and in a correct manner. Okay, beautiful. So the next two that we find very, very often and that you'll find daily in all kinds of opportunities across the market is you get these falling wedges or falling channels, and then you get these rising wedges or rising channels. Now, what we need to understand about this is markets are a culmination of impulses and corrections. Okay, so, and I'll show you this on a chart as well a little bit later. So a market is just no matter how big the structure is that you look at, right? When you zoom in, you'll find that markets move up, correct, move up and correct. So markets are just full of impulses and corrections, impulses and corrections. So what we find in terms of some of these channels and wedges is that when we have for a descending wedge to be true, we have a bull impulse, so market that raised or rised up. We then have a wedge that is a correction, with the likelihood of breaking topside once that correction has ended. Now, this becomes extremely powerful when we pair this with Fibonacci, because we're able to look at the distance of that impulse, measure the correction down to a known Fibonacci level, 61.8, 78.6, 88.2% as an example. And then once we get those levels, we can start to proactively, in the case of a falling or descending wedge, buy at a level of support that coincides with a retracement or a correction, with the ultimate goal here of buying that breakout and the next impulse towards the top side that should support our trend. That is what it's all about. Now, when we talk about a rising or ascending wedge, this will generally be on the back of a big bear market. So when we've had an impulse towards the downside, then we have this rising or ascending wedge as a correction towards the top side. Again, we can utilize Fibonacci to measure the impulse move towards the downside, and we will generally wait for this rising wedge to correct up to a known Fibonacci level, 61.8, 78.6, 88.2. And once that correction has been completed, we will then look for a sell opportunity, hoping for the breakout towards the downside and the continuation of the next impulse leg. So a lot of the times when you see these price action formations, it's important to obviously understand where price came from, what the story of price is, and what state of the market they are obviously being observed in, because you can see them in all different time frames. You can see them big time frames, smaller time frames, and this is obviously will determine how we trade these particular items. Now, these rising and ascending wedges or channels, these are going to be your favorite friends in the early days, right? You can go to almost any time frame, almost any asset class, drill in right down to 15 minutes, and you can start to see some structures, some rising wedges, some falling wedges, and you can start to obviously capitalize on buying within the structure, buying and selling within the wedge itself, because some of these wedges can take days to obviously form and or obviously complete. So you can take advantage of all of those moves, or ultimately you can wait for the breakout to happen with a position in the direction of the breakout, right? Proactively taken within structure, if you will. So these are two classes, I think, of probably the most commonly traded price action formations that are out there, and extremely profitable, extremely consistent. Now, again, I must say also as a disclaimer, these things are not written in stone. So if you see a falling triangle, it doesn't mean with 100% certainty this is going to break towards the downside. We do see breakouts towards the top side. We see fake breakouts. It's just you setting yourself up for a high probability, because these formations are only telling you of what is happening within the markets in terms of participants, right? It's a visualization of an imbalance between buyers and sellers that ultimately would culminate in one of them winning and one of them losing. So it's a high probability move, not extremely high, it's not 100%, but you know, even 60-70% is good enough. Like I said, with risk reward, risk management, everything playing towards your favor, you're still making good money in the times that you win these particular trades. So that's just the quick disclaimer, in my opinion. I think I have to add that for legal purposes, I'm not 100% sure. But anyway, moving on. The next items that are obviously also quite popular and we see quite a lot is where we see the different flag formations. So what a flag formation is when we see a very sharp impulse in a market. So example, we see a flag up reversal, which means that we see a sharp impulse in the market, which comes to a very quick stop, and we start to see a corrective pattern. Now, this can often be mistaken for a correction, whereby we get a impulse in the market and it starts to correct down and can start to look like a channel. It can start to look like a descending or falling channel, where we would expect then for this to correct down to a known Fibonacci level and we'd continue the impulse up. However, it looks distinctly different in the sense that the preceding trend is extremely straight, right? It's extremely strong. It's a sharp impulse topside and this sort of slow correction within this smaller descending channel formation. Now, this is generally what we refer to as a reversal pattern, meaning when we spot these flags, a lot of the time we end up seeing price then break back down, and this becomes a reversal of the impulse that we saw rising. Equal and oppositely, we see a flag downtrend reversal where the flag is almost kind of on top of its head. We see that massive impulse, we see that correction, and then we see markets break back up towards the top side. So these are also quite popular, except they're a little bit harder to spot, like I said, because of the potential differences between a descending channel or descending wedge or rising channel, rising wedge. People often mistake these two. The real difference here is these ascending channels and descending wedges. They require a bull market, a normal bull market structure preceding a descending channel or descending wedge, whereas in this particular case, on a flag uptrend reversal, we see that the impulse is dramatically different. It's 2-3 candlesticks long, separated, completely outside of structure that just push up, start to consolidate in this fashion. Then we see that reversal tend to happen at that particular point. So it's just about keeping your eye out there for these ones, and generally speaking, you want to trade these guys in terms of a breakout. If you're lucky enough and you catch them within structure, you obviously can take advantage, but generally speaking, you want that breakout to happen and materialize so you can obviously take that towards the downside. Now, the next patterns we're talking about are continuation patterns, and these are referred to as pennants, right? So looks very similar to a flag setup. The difference is how that consolidation happens once the impulse happens. So we see in the same way, we also see a bit of an impulse in terms of that move towards that builds that flagpole. So we refer to this as the flagpole. This can also be referred to as the flagpole, and the pennant will also have a very sharp move towards the downside. However, the consolidation will look slightly different, right? We will have a symmetrical triangle formation where we're making lower lows, lower highs, and we're coming towards this point of an apex being that final moment right there at the end on that actual pennant. Now, what we look for here is we look for a continuation of the preceding impulse. So we had that impulse down, that consolidation as a symmetrical triangle. We reach that point of apex, and then we receive that breakout towards the downside. Again, opposite and equal is true for a pennant up. This looks like a normal flag standing up. We get that nice sharp trend creating that flagpole, that consolidation in a almost symmetrical triangle formation, and then at the point of reaching apex, we then see that continuation move towards the top side. So these are some of my favorite. These are some of the ones that I spot the most and have quite a lot of fun with in spotting, just because once you see them, it gives you an ability to proactively start to set up some of your trades and some of the opportunities that obviously we have in looking at them. Okay. So as with candle formations, we have many different price formations structured. We've got heads and shoulders, we've got double tops, triple bottoms. We've got a ton of other things out there in the markets. And, you know, to be honest with you, I want to deliver to you the items that are the most consistent and most profitable in the markets. Now, in a lot of cases, we had, you know, double tops, double bottoms, triple bottoms, head and shoulders. But ultimately, it's about looking at the price action formation, what price is doing and what that breakout ends up doing. We see a lot of head and shoulders formations, but that can also be interpreted in other ways depending how we see that market. And a lot of the times when we talk about a head and shoulders, and I'm not going to go into it, but the right shoulder will fall outside of market structure, already giving us an indication that that's going to sell. And I still find that looking at it from a more purist form of view still gives you the higher probability in terms of that particular outlook. But these may be things you trade, and if that's something you trade and you find profitable and you enjoy, please let me know down below in the comments. I'll make sure to have a look at that and get back to you. We may include it in the next series, but ultimately we want to obviously cut out as much of the gobbly-gob as we physically can for every single one of you. So if you guys remember this chart we originally started with, that originally was random. When we started the support and resistance, this was a random chart, and we obviously showed and drew in some of that support structure, some of that scaffolding. But what's more interesting in terms of that support structure is we start to see now a lot of these price action formations playing out, and I can now start to show you some of these items. So we see here we have a descending triangle that initially started and kicked off this whole procedure. And initially I said to you that we can kind of see and understand where market is going from a structural perspective, because we're seeing less buyers active in this sideways consolidation, if you will. We're seeing a lot less buyers active and participating here. So the likelihood of the breakout towards downside was there. We see it was within the 50 to 70% mark. It ultimately did break out, came back for that retest. We then see, once the retest was completed, we then see markets then immediately started. There's actually one even before that. That's one over there. We see that we have that rising wedge or rising channel. Again, that is a consolidation of that previous bull market. Okay, and we're able then to even measure that, and this would have been to my belief also a 61.8 in terms of that movement from natural swing low to natural swing high, and we'll get into that as well. Markets move further down, we see another rising channel. Markets move down, the same thing, and then we start to see the change of that market structure. We start to see a new market formation that starts to happen, and then we get that continuation pattern that we look for. So we get that pennant where we start to get that consolidation in a symmetrical fashion, which starts to tell us we're going to see that next breakout towards the top side. It'll be a continuation in the original direction of that particular trend. Now, if you go back and you draw out the support resistance, you draw the channels, you draw all the things that we've taught on this particular chart up until now, you'll have quite a comprehensive view of that there is zero random about the charts and the movements that have happened until now. Yes, it is a snapshot, and it's really easy in retrospect to go back at any point in time and point out all these things, but this is what we aim to spot as price action traders. We aim to spot these formations as and when they're busy happening, and then even more, we're able to then go ahead and apply more technical tools, which is what I'm going to be explaining up next, which is Fibonacci, that helps us to further measure where these corrections or where these channels may end, so that we can take advantage of those breakouts and all the different formations that will obviously happen there on after. Now, there's a ton more happening in this particular chart, but we obviously cannot zoom in, we can't play around, but there's a ton more happening that would justify and cement some of these price action symbols. But just to show you that there is nothing random about the markets. There can be times where things cannot be explained, where we see all the price action in the world, we get all the fundamentals in the world, and markets just do what they want to do. It happens. It's reality. It's data, right? But in most cases, markets are giving us a lot of clues as to what they want to do without the use of any indicators. And there's no indicators in the world that will predict price action or accurately draw it out, because it is largely a subjective study. We see price spike, or we see these wicks and we see these candles, a lot of software will look at this and get confused. Is it the top of the candle? Is it the top of the wick? Is it the average of this market structure, what is it? A lot of software freaks out and cannot understand what we are able to process and see with the human eye, and thus the reason why price action has been such a staple form of analysis and why I believe it will continue to be moving forward. Now, price action is what we incorporate in all of our trading. Again, these are things I want you to go onto your chart, pick a chart, open it up. When we get into the strategy, I'm going to be showing you how to identify some of these things, and I want you to put in the time and I want you to practice this. Again, without the use of different types of indicators, I want you to have a clean raw chart in order to deploy some of this information and get that practice and just get in that much needed time that you obviously need and you deserve behind the charts to obviously make sure what it is that you are doing. Now, moving up next in terms of price action comes one of my favorite things in the whole world, and that is where we're going to learn to obviously understand and deploy Fibonacci, right? Again, as I explained, the full strategy, for it to be deployed, one of the key technical tools that I love and I use on a daily basis, I look at life, I look at traffic, I measure things in my head in Fibonacci, right? I measure all kinds of things around the world in Fibonacci. It's just an absolutely amazing thing, and it just keeps going deeper. We can see that some of these corrections and these opportunities were presented with the use of Fibonacci, understanding where these corrections were going to happen. We're all parts and parcel of understanding where Fibonacci sequence is applied, and how we use that is extremely important. I'm going to dive into that in quite a bit of detail. So let's get going. All right, so Fibonacci, again, let's go. Probably one of again, said it a million times, one of my favorite teachings. So what is the Fibonacci sequence and why is it so important? I can assure you this is going to blow your mind. This is the Fibonacci sequence: 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144. Okay, so thank you, Dane, for that. Why is that so important? Well, these numbers are quite special, and I'm going to show you what this all means, right? So the Fibonacci sequence, against popular belief, was tracked back to Indian literature back in 200 BCE, right? A lot of people say that this individual that I'm going to talk about next invented it, or whatever the case may be. He didn't. The Fibonacci sequence was in Indian literature way back in 200 BCE, right? It was brought to and discussed in Europe by a gentleman by the name of Leonardo Pisano Bugalio, right? An Italian individual, right, who was known in mathematical history by several different names. Leonardo of Pisa, Pisano means from Pisa, and Fibonacci, which actually means the son of Bonacci, right? Fibonacci, right? This is what he's most commonly known as. So in 1202, Leonardo of Pisa, or Fibonacci, published the massive tome Liber Abaci, a mathematics cookbook on how to do calculations, right? Written for tradesmen as Fibonacci, laid out a Hindu-Arabic arithmetic useful for tracking profits and losses, remaining loans and balances, and so on. So they used to use the Roman numerals, right? Those crazy numerals, the V's and the I's and the whatnot. And they found it was very difficult to obviously do things like subtraction, multiplication, just basic, in today's standard basic mathematics. And so this Liber Abaci was written and brought into Europe as a different way of doing math and tracking, all these debts and these ledgers that these tradesmen had, because obviously Italy was one of the leading financial trade hubs within the world at that particular point in time. The Fibonacci first introduced the sequence to the Western world, but after a few scant paragraphs on breeding rabbits, it was all around about this whole rabbit experience. Leonardo of Pisa never mentioned the sequence ever again. So pretty much after the 1200s, right? It was never mentioned again to almost the 1900s. It was mostly forgotten until the 19th century, when mathematicians worked out more about the sequence mathematical properties. And in 1877, French mathematician Eduardo Lucas officially named the rabbit problem as the Fibonacci sequence. So actually someone completely different named it the Fibonacci sequence after this particular Leonardo of Pisa, or alternatively called Leonardo Pisano Bugalio. Okay, so this was originally not designed for the intended purpose that we're using it today, but it was a consequence thereof. Once we started to understand it, once we started to apply it, some really crazy things started to evolve. I can go as far as saying that many have said that the Fibonacci sequence and the golden ratio is what many believe to be the fingerprint of God, right? The mathematics that God left in all creation that we were able to find through maths, and it's some really, really crazy things, and how it ties back to the markets will blow your mind. I'm super excited. Let's get into this. All right. So now let's have a look at this number sequence again, because there's some pretty bold claims and pretty bold statements that I'm busy making here. So 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 337, and 610. What does it all mean, right? So each number in the sequence is a sum of the two preceding numbers, right? So 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, 5 plus 8 equals 13, so on and so forth, right? Now, the interesting thing is that when we divide any of these two numbers against each other, we receive the same answer. Now, again, when it comes to basic numbers, smaller numbers, it's harder to get the exact number, but the bigger you go, the closer to this exact number and this exact sequence we do end up getting. And that ultimately is 1.618, or otherwise known as just 61.8. Okay, 89 divided by 55, 1.618, 2610 divided by 377, 1.618, so on and so forth. But thanks, Dane. Like, we want to learn how to trade. We're not looking for a math lesson. I get you. I feel you. Hold on. I promise you it's going to be worth it. Let's jump even deeper. Okay. So when mathematicians started studying and observing these different number formations, they started to see some really crazy things, and they observed a lot of these things through nature, right? So they observed a lot of these symmetry or these symmetrical properties in nature, and this started to evolve into the natural world as we see it fit. And this is how this number sequence was derived from a visual perspective, that if you made a block 1 by 1 big, right, and you made another block next to that, the Fibonacci sequence 1, 1, 2. So 2 blocks next to each other. Then the next block under that was 2 by 2. The next block under that was 5 by 5. Then 8 by 8, 13 by 13, 21 by 21. You started to receive this perfect spiral, right? And this was often referred to as the Fibonacci spiral. And what they started to find is that this Fibonacci spiral started to visually show the, in a sort of a calm way of saying it, the visualization of perfection, right? They started looking at art, they started looking at Mona Lisa, they started looking at the perfect face, the perfect symmetry or perfection, and what they started to see is that this spiral or this golden rectangle represented everything that was essentially designed as symmetrical or perfect. Okay, now that's just from man-made creations, but how does it go even further than that, right? This is obviously the visual perspective. Now, it was found that this golden ratio, or that this golden triangle, was also found in nature, right? Now here's the crazy part. I want you to look at your face, right? And this is obviously the definition of symmetry, and our minds, we've been told and we understand that our minds see symmetry as beautiful. But ultimately, take the height of your face divided by the width of your face, and you receive roughly the answer of 1.618. Okay? Divide the distance of your hand to the total distance of your forearm, you receive the calculation of 1.618. Divide the distance of your whole arm in relation to the height of your body, and you get 1.618. Okay, Dane, this is getting strange, but what else? When you look at the human DNA spiral, right, we find that the golden rectangle and the golden spiral is the exact geometry of the human DNA spiral. That's not only found in the human DNA, but it's also found in certain molecular composites that are found in space. Most flowers in nature only have petals and seed arrangements within the Fibonacci sequence. So it's either it'll have either a set number of flowers, and this will be either 5, 8, 13, 28, 21, 34, 55 flowers or seeds within that particular arrangement. Most flowers in the world. If we look at seashells, most seashells that have been created in nature, most probably famous is the Nautilus shell. Let's just have a look there. Are generally created, and their spirals all form around this golden spiral, right? Honeybee colonies, right? We understand how important the honeybees are to the production of all food and everything within the world. This is another example that will blow your mind. They found that in honeybee colonies, if there isn't exactly 1.618 female bees to every male bee in a colony, if that number is just off by a slight percentage. So they took these colonies, healthy colonies, where there's exactly 1.618 female bees to the male bees, and they just removed a handful of female bees just to throw that number off slightly. The whole colony died. Okay, there needs to be exactly 1.618 female honeybees to male honeybees within a colony in order for it to survive. Moving on, and this is going to start to hopefully blow your mind, is that in every place that God gave commandments for man to build something, he gave commandments for things to be built in the exact measurement of the Fibonacci sequence. So if you go back to the Bible, things at that time were measured in cubits. The commandment was given to build it in X cubits by Y cubits by X long, and if you go back, you will actually see that these are all Fibonacci sequence numbers, and when you divide the numbers against each other, you get exactly the same answer every single time, 1.618. If you look at Noah's Ark and the dimensions of how it was built, every measurement that was provided in order for how it to be built comes back to the 1.618 or the Fibonacci sequence. Okay, there's more and more and more examples. We can go extremely deep. I would love to even get to the point one day of even getting to the point of writing a book about this. But ultimately, the Fibonacci sequence and the golden ratio is visible everywhere in nature. The more we look, we find it within our bodies, we find it in nature, we find it in animals, we find it in all these different things. And so what ended up happening is that mathematicians started to look at this phenomenon and started to look at this Fibonacci sequence and started to see all of these crazy things, that civilizations would grow, they would have a season of impulse, but the correction could be measured by the Fibonacci sequence. So you have these seasons of impulse, of growth, and there would be a natural correction down to a known level, something like 61.8, which is called the golden ratio. Right? You look at civilization's growth. If you look at nature, animals in nature in terms of their population expansion and contraction, and ultimately what the Fibonacci sequence does, specifically in the tools that we're going to be using in the financial markets, they started to realize and see that markets would expand and contract in alignment with the Fibonacci sequence. So we would see markets expand, we would see an impulse. Markets would move whatever the duration, it doesn't matter. But we would see a period of correction down to the 61.8% of that market move up. So the market moves up 100%, come back down 61.8% of that move up, and then would continue in its next impulse. So ultimately, what mathematicians, scientists, biologists, all these different people started to find, and there's more and more evidence coming out as this is further being studied, is that in everything man-made, everything comes from nature that God created, there is this constant number that we're just starting to uncover and starting to understand, which is this hidden message, this hidden math of this sequence and this constant reoccurring 61.8 everywhere in nature. And the link to markets is absolutely mind-blowing. And when I show it to you and you learn how to use it within the markets to measure these impulses and corrections, because remember, that's what markets are: impulse, correct down to a period, impulse and correction, it will blow your mind. Now, when we look at economies, right, we look at there's times of growth. Nobody speaks about the times of growth as we in this impulse, we're in this amazing season of growth. They call it growth, but really this is an impulse of growth. And when they talk about a recession, oh no, we're in a recession. A recession is another word for correction, right? A correction is just a natural movement of something that grew too fast. It's coming back and correcting for the next impulse or the next season of growth to come. And we can physically measure that again using tools like the Fibonacci retracement. Now, this math and the secret code has been developed into a bunch of different tools. We get Fibonacci retracements, we get Fibonacci expansions, we get the Fibonacci arcs, we get Fibonacci time zones, we get a ton of things. But for the purpose of this particular series, I'm going to be teaching you about how to use the Fibonacci retracement tool. So let's have a look at that exact same setup that we were looking at a little bit earlier, and let's look at it in the context of a Fibonacci retracement tool. Okay, let's have a look here. So the exact same price action formation that we saw come back a little bit earlier, we can see happening right here, and there we go, right? So we can see that markets impulse towards the downside. We can grab the Fibonacci retracement, draw it out, and we could physically see that that ending to the market was not random. Yes, there is a market structure also at play, but if you tie up that market structure with the Fibonacci technique, we can also then see that markets came back to that perfect number, 0.618. Markets came back, corrected, touched that number, and continued on to this next impulse towards the downside. Now, this is an amazing tool. It's something that I highly recommend you guys spend more time on. Now, there is a little bit of setup required, and obviously to get it all sorted out. As a standard tool, it is available within MetaTrader, but you need to add some more levels in to get it working perfectly and to its absolute utmost. So I'm going to show you how to do that really quickly. So let's open up our trading terminal. I'm going to jump in here, I'm going to open up my trading terminal, and I'm going to show you what this looks like, how do we access it, and how do we set it up, and how do we customize it. You may want to rewatch this video if you missed it or I've gone too fast, and again, you're more than welcome. It's yours, it's free, it's in your hands, you know what to do. Okay, so let's jump into it and let's have a look. So when we look at MetaTrader and we go to insert, insert, and we're obviously going to look for from a tools perspective, we're going to look to try and add in here some of our Fibonacci tools, because this is obviously just a tool that we can obviously extract and get to in terms of just being a normal tool. Just like you have a trend line, just like you have any of these items, this is seen exactly in the same way from a tools perspective, right? So let's just get in here. So we want to insert and jump into our objects list, and then we want to scroll down and navigate towards Fibonacci. And then you're going to see there's retracements, time zone, arcs, fans, channels, expansion. For this particular purpose, we're going to jump on and select our Fibonacci retracement. Now again, as I said earlier, how this works is that we're looking to measure a particular impulse in a market. Okay, so in this case here, we can see this market's impulse down. Let's say this market's trending up. We want to then measure that. So how we utilize that is when a market's trending down, always, no matter which way it's trending, we start from left to right. So if a market was trending up, from left to right, so we'd start the drag process from the bottom left all the way down to the right, okay? And this would help us to then see all of these levels that we're seeing here down below. And have a look at how amazing that is, right? So markets pushed all the way down. The first level that it stopped at was the 23.6, then the 38.2, then the 50, then the 61.8, and then we got that rejection. Markets broke through, found support 61.8, 61.8, 61.8, failed, and then moved along their merry way. And you'll find that these levels are still relevant even if we had to drag them all the way to where we currently are in this moment of time. They would still end up framing and giving an identity to this particular market in terms of structuring some of these moves that the market is busy having. Now, there requires a little bit of a setup, and so when you get your tool, it may not look the same as mine. So you want to go into the tool, you want to hit on double click, unlock it, you want to go into the properties, and you want to now edit some of these levels. By default, you should be getting 0.236, 382, and 0.5 as well as 0.618. What you want to add here is all of the rest. So I want you to pause here. You can try and zoom in if you will, but you want to add in 1.618, and that is going to be 161.8, and you're just going to add in a new level. You're going to type in the next level. The next level you want to add in here is going to be, most importantly, you want to add in 0.786, and the description is going to be 78.6. You want to add in 0.882, and description is going to be 88.2, and 0.236, description is going to be 123.6, and so on and so forth. 1.382, description is going to be 138.2, 1.5, description is going to be 150, and 1.786, description is going to be 178.6, 1.882, description is going to be 88.2, and you're just going to leave 0 as 0. So you can obviously pause, rewind, make sure you get those values, and all you want to go ahead and do once you've added in all those values, you just want to click OK. You can customize it to obviously look the way you want it in terms of the common properties, draw as a background object, set the line thickness, and set the color. But the most important thing is how to deploy it and how to use it, right? So when we see that a market is busy trending or that there's something happening in a market, so we'll use this as an example here, right? We see this market moves up, comes back down, finds a level of support, moves up, comes back down, moves up, comes back down. In a lot of these cases, these are the impulses that we're seeing, and these are the corrections. We want to find out where do these corrections end. So we'll start over here. We'll have a look here. We'll measure this impulse up. Okay, and we can see that markets come back down to the 78.6. Great. Okay, we want to measure this impulse up, and we can see that markets came down all the way to the 88.2, but it ultimately stopped at the 88.2. Great stuff. We want to measure this next impulse up. Let's have a look here, and we can see that markets barely made any decent retracement at all and didn't make it back to this level of support, which is great, which is fine. We look at this next impulse up, and we can see that markets came down to the 78.6 as well as made a touch for the 88.2. So we can see in this market structure, and this is VIX 75, VIX 75 likes to come all the way back down to an 78.6 or 88.2. So again, each currency has got its own type of personality, if you will, and what it likes to do from a trend perspective. Again, markets move up, comes back down to the 78.6. Again, this market is a rising market, right? We're starting to see a little bit of the signs of some sort of triangle formation, but again, it went past that 50 to 70% mark, and then you can see it acted haywire, broke up, broke down, so on and so forth. But ultimately, how this allows us to trade is we want to try and buy off of support, because ultimately this market was rising. Fibonacci allows us to measure that corrective movement where it would potentially end, and allows us to obviously jump into that particular market. Now, if we look at a market that may be falling or going down, here's a market here. We see an impulse, markets come back up. We want to know where will that stop. We can then measure, remember, from left to right. We deploy our Fibonacci, and we can see a perfect stop there on the 61.8. Great stuff. Okay, so you can measure markets that are rising, markets that are falling, and then you can have a proper probability of where that may end up ending. So over here we can see we don't have any of the deeper Fibonacci numbers, right? So in this market structure over here, we can see that markets had an impulse towards the downside. We started that channel correction towards the top side. That channel only got to 50 and ultimately broke. The second that broke, that next move was then to the downside, right? The next move was to the downside. We can see then we have another channel there from a price action formation perspective. It could be seen as something along that nature over there. Markets tried to break, broke down, retested, and then moved. So where we have these deeper corrections, then Fibonacci acts as a great tool to obviously understand where will these corrections end and how can we obviously take advantage of that. So again here, markets corrected topside, came back down. We start to see a new trend form. Then we can start to deploy our Fibonacci to understand, okay, where will this market correct to? Markets pushed up, came back, hit the 61.8, tried for the 78.6, and then we have that continuation topside. Over here, markets pushed down, came back for that correction. What is that correction value? Let's have a look. It is once again the 61.8, but then touched on that 78.6 and continued toward the downside. And the story goes on and on and on and on. And you'll find everywhere that you see correction or everywhere that you see patterns within the markets, they form and conform to some sort of level within the Fibonacci sequence. It doesn't matter where it is that you look, you will continue to see and find these patterns no matter where it is you look. So it gets absolutely crazy and you can become obviously obsessed with it, but it's a really great tool to utilize within your trading, along with price action, along with all these other techniques that I'm going to be showing and I'm going to be sharing with you, because ultimately we're going to now be jumping in the next episode, the next video. I'm going to be unpacking the full quantum growth market strategy, and Fibonacci forms an integral part of understanding how to obviously complete that analysis. And it's a great tool that I wanted to impart with every single one of you. So let me know what you thought about that. Let me know what it is you're thinking. Ultimately, this is a tool I'd love to see you guys using. It takes practice. You got to put time in behind it, read and research as much as you can, as much as you want to. Obviously, in the Quantum Growth Masters, I teach about all the other derivatives of the retracement tool, right? We talk about the expansion, we talk about arcs, and we talk about time zones, and we go absolutely crazy. But it's just generally a really great mathematical tool that we love to use within markets, and the probabilities and how it plays itself out is mind-blowing. I've had students from all over the world just come back to me and say, this is something else. It's absolutely amazing. Again, it matters in terms of how you deploy it and what environment you deploy, but done right, the outcomes are absolutely mind-blowing. So guys, I trust you've enjoyed this section on price action. I trust you've learned. As always, that's what it's all about. Let me know what has been your favorite part within this video. If there hasn't been a favorite part, let me know too. Again, it helps the algorithm. As always, like, subscribe, hit that bell notification icon, turn all notifications on, so any new future content you will obviously get notified on, even if you've completed the series. We're going to be doing a ton of things. We're doing some things in terms of cars. I'm going to be doing some gaming, streaming as well, so you'll be notified about all of that moving forward. But up next, in the very next episode, the very next video, I'm going to be unpacking the full strategy from start to finish, and you do not want to miss this no matter what. So I'm going to let that music come in. There's been some sweet tracks, sweet music. And how are you guys finding the music, by the way? Is it your taste? Is it your style? Is it too much, too loud, too soft? Love to hear your opinion. Let me know. Otherwise, outside of that, I hope you guys have had a great time with me. Thank you for joining. I'll see you guys in the next video. Shalom.